Hey, welcome. Today, we're going to pull back the curtain on something that affects millions of us, the price of life insurance. We're going to break down how that price is actually calculated, and we'll be doing it based on the fantastic work of Dr. Sudhindra S.G. All right, let's dive right in. Okay, so picture this. You get a quote for a life insurance policy. It's just one number. But where in the world does it come from? Did they just pull that number out of thin air? Is it some kind of guess? Well, I can tell you the answer is a big, fat no.
See, that price is actually the result of a very specific, carefully built formula. And that's exactly what we're going to do today. We're going to take that formula apart piece by piece so you can see exactly what you're paying for.
So let's start at square one. You hear this word premium thrown around all the time, but what exactly is it?
It's pretty simple, really. The premium? That's just the price of the policy. It's what you pay, and in return, the insurance company promises to protect your family financially. You can kind of think of it as the ticket price for your peace of mind.
But, and this is a big but, that price isn't the same for everyone. Insurers have this starting point, this base price, for what they consider a standard risk. Think of a healthy person with a safe desk job. But what if you have a health condition, or maybe your job is a little more adventurous, like a professional mountaineer? Well, then you're considered a substandard risk. And that means they're going to tack on an extra charge to that base price just to cover the higher chance of a claim.
But hey, it's not all about adding extra charges. You can actually get discounts, or what the industry calls rebates. A lot of times, insurers will give you a bit of a price break for buying a bigger policy, one with a higher sum assured. And the reason is simple. It costs them pretty much the same in admin fees whether the policy pays out $100,000 or $1 million. You know what else gets you a discount? Paying once a year instead of every month. And why is that? Well, again, it's just way cheaper for them to process one big payment than 12 little ones.
Okay, so we've seen how the price can get tweaked up or down, but what's at the very heart of it all? The core calculation? Well, it really boils down to just two secret ingredients that a special kind of expert, called an actuary, mixes together to build the price from scratch.
Ingredient number one, and this is the big one, is mortality. This is basically just a fancy term for the statistical probability of death for someone in your age group. I mean, think about it. If you're insuring a group of 25-year-olds versus a group of 65-year-olds, you know statistically you're going to pay out way more claims for the 65-year-old group, right? So actuaries use these things called mortality tables to figure out that precise risk. And yeah, the higher the risk for your group, the higher the base cost of your insurance is going to be.
Now, ingredient number two actually works in the opposite direction, and that's interest. Because let's be real, the insurance company isn't just stuffing your payments under a mattress. They invest that cash, and they earn interest on it. And they actually factor those expected earnings into your price, which lets them charge you less today. It's like a little seesaw. The higher the interest they think they'll earn, the lower your premium can be.
Okay, so you take that mortality cost, you subtract the money they expect to make from interest, and what you get is something called the net premium. This is like the pure rock-bottom cost to insure you. But, and this is important, that's not the price you actually end up paying.
Right, so that net premium, that's just the starting block. To get to the finish line, the price you actually pay, they have to add in all the costs of, running a business. Think of this as the step-by-step recipe for your final price. First, they start with that net premium we just figured out. Then they start adding layers. They add something called loading for all their expenses, then another layer for just-in-case stuff, or contingencies. And for some policies, they'll even add one more layer for future bonuses. And when you stack all of that up, you get the gross premium. That's the final number on your bill.
So what the heck is this loading stuff anyway? Well, it's pretty much everything it takes to keep the lights on and run the company. We're talking agent commissions, staff salaries, office rent, all that administrative work. And it also includes a really important safety margin, a little cushion, just in case their original guesses about mortality or interest were a bit off. Okay, but what happens when things go better than they planned? You see, insurers are naturally cautious. They plan for the worst-case scenario. But a lot of the time, reality turns out to be better than their predictions. And that leads to something really interesting. When a company's assets, that's all the money they have, are worth more than their liabilities, that's all the future claims they've promised to pay, that leftover bit is called a surplus. You can think of it like a profit that shows up because, hey, fewer people made claims than they thought, or their investments did way better than they'd hoped. Now, for certain kinds of policies, they're often called with-profit or participating policies. The company doesn't just pocket all that extra cash. Nope. They actually share a portion of it with their policyholders. And that share comes to you as a bonus. You've got a simple bonus, which is calculated on your original policy amount. Pretty straightforward. Then there's the compound bonus, which is way more powerful because it's calculated on your policy amount plus all the bonuses you've already piled up. And sometimes you might get a terminal bonus, which is like a special one-time loyalty payout at the very end. A little thank you for sticking around.
But wait, this whole traditional model we've been talking about, it's not the only game in town. There's a totally different approach where you, the policyholder, get to be much more hands-on with the investing part.
And here's the absolute key difference. It all comes down to one question: who takes the risk? In a traditional policy, the insurance company takes all the investment risk. They guarantee you a base payout, period, no matter what the market does. But with a unit-linked policy, you'll hear it called a ULIP, you take on the investment risk. Your money buys units in something that works a lot like a mutual fund, and what you get at the end depends completely on how well those investments do. The potential reward is higher for sure, but so is the risk.
So, at the end of the day, what does this all mean? It means that premium you pay is so much more than just a price tag. It's this really fascinating formula that's carefully balancing the cold, hard stats of risk, the power of investing, and the simple, real-world costs of running a business.
And look, understanding this recipe, that's powerful. It completely changes how you look at a policy quote. It's not just a number anymore. It's a whole story about risk and return and responsibility. So the real question for you is, now that you know the ingredients, what are you going to look for in your policy?